Hey guys, hope you're doing well out there. First here on the channel, taking a look at the Trade Desk Incorporated, ticker symbol TTD, and in the after hours, shares are absolutely crashing and burning, down nearly 26% over the past 1 year. You've done relatively well, up 63%, in fact outperformed other advertising names like Meta and Google. But the thing to note here is with these names that have gigantic valuations, when things go wrong, they go wrong really fast, and the market certainly turns on stocks like these rather quickly. So we'll take a look at what went wrong over at the Trade Desk from a financial perspective, also take a look at it from a technical perspective. It's looking very ugly. You're breaking through multiple levels of support. We'll highlight maybe a level where shares could be considered a good value and maybe where they might find further support. Hey guys, hope you're doing well out there. Like we said, first time covering Trade Desk here on the channel. We have covered other advertising names like Snapchat, Pinterest, and Reddit, and I would say the Trade Desk sort of falls in that third tier category in terms of advertising. And let me explain that a bit further. So if you were to rank all of the advertising companies in terms of their advertising strength, I think it's safe to say you have Meta and Google right there at the top, and then you have other advertising names like Netflix, Amazon, Disney, and Spotify as sort of your second tier. And then where the Trade Desk lands, in my opinion, is on the third tier in terms of advertising strength. Next to a Pinterest, Snapchat, and Reddit, you have very similar sort of companies in that third tier where they haven't reached the same scale or reached the same network effects that is really required, at least in the advertising space, to turn meaningful amounts of profit. Because look, Meta and Google have reached that scale. Even Netflix and Amazon now, to a certain extent, have reached that scale. And what scale and network effects in the advertising space show is that you can turn revenues into meaningful amounts of profit. Until you reach that level of scale, it's very difficult to be profitable in a highly competitive advertising space. And that is what these third tier companies are seeing. Now, the other thing to note about third tier advertising companies is a certain number of red flags. Because look, we know Google, we know Meta are fantastic names. They've certainly gone through their phase of ultra high revenue and expense growth, but these third tier advertising names that are still relatively young, still maybe have went public very recently and are still in a scale up phase, well, they have some red flags to watch out for. The first one is stock-based compensation. We'll take a look at this particularly with the Trade Desk. You'll see it's looking very egregious. The other thing to note is maybe some uncontrolled expenses on the operating expenses and capex side. And the third, I think the most important thing to note though, is these companies like to take out press releases and presentations that are maybe 50, 60, even 70 pages long, and they like to throw on a bunch of different metrics and a bunch of different graphs and charts. The important thing to note though is they tend to hide some results which maybe don't look as good. And so as an investor, it's up to you to dig in, take the time to go over the financials, especially for these third tier advertising companies. And as an investor, the vast majority of your dollars should remain with Meta and Google, especially in the advertising space. Then you can sprinkle some along in these third tier advertisers, because look, when things go wrong, you can have a huge amount of your value and capital be wiped out in a single day. And so that's what you're seeing over at the Trade Desk. Even though over the past 1 year you've outperformed names like Meta and Google, you're seeing a lot of those gains get wiped out in the after hours. The other reason for that is because you still, despite probably this nearly 30% decline, have a gigantic valuation on this name. I just have a price to sales pulled up compared to a Meta and Google, and while the Trade Desk is trading as much as 2, 3, even 4 times as much as a price to sales compared to Google. Now, one thing to note though is the revenue growth over at the Trade Desk is faster than both Meta and Google. So that's something to consider. That's why you get maybe a slightly higher premium on your price to sales. But as we see, is that growth rate fast enough to be given a nearly 25 times price to sales multiple when you have very high quality companies like Meta still growing relatively fast, trading around an 11 times price to sales multiple? And all of that comes into perspective with the Trade Desk's Q4 results, which came in at 22% growth year over year on that revenue side. Revenues coming in at $741 million. Now, again, for a company with gigantic valuations of 73 times a forward multiple, nearly $60 billion, $60 billion in market cap, posting just $740 million in quarterly revenue. And keep in mind, this is the Q4. This is when advertising is certainly at its best. For all of these advertising companies, they tend to have gigantic Q4s. And even then, you're putting up a quarter of $740 million in top line revenue for a company valued at nearly $60 billion. Now, if that wasn't good enough for you, that also came in underneath expectations by close to $19 million. In fact, the expectations were for growth of close to 25.5%. the trade desk showing it was only able to grow nearly 22% in the Q4. So that is certainly red flag number one right there. When you have companies with gigantic valuations and they're let alone unable to come in and beat expectations, if they come in and miss expectations that are set out by Wall Street, well then get ready for the stock to get absolutely hammered like we're seeing in the after hours with this company. In terms of their bottom line, they did come in with a slight beat, although I would consider that more so in line. And the other thing to note is with high growth companies like this, whenever the growth rates begin to slow down, if they're showing signs of slowing down, well, that will absolutely scare and spook investors that are looking for ultra high growth, because you're showing that the company isn't able to come in with those rapid growth rates it may be once used to. The other thing they did announce was a roughly $1 billion share buyback. Bit questionable to see this company buying back shares at these elevated levels, considering now shares are about 30% cheaper, but hey, I'll let you be the judge of that. The other thing to note though is probably the other reason why shares are sliding so much in the after hours is because you got guidance coming in underneath expectations. Revenue expectations were for closer to 582 million for the upcoming Q1. The trade desk guiding for revenue to come in around 575 million. So look, you look ahead into Q1, analysts on Wall Street were expecting nearly 19% revenue growth. Well, we just got told by the trade desk they're not going to be able to come in and meet that. And so that brings into question Q2, Q3, and especially Q4. How will this company put up revenue growth of nearly 20% in all three of those quarters when they're telling you they'll probably come in around 16 to 17% growth in the upcoming Q1? And so in a couple of days, you'll probably notice analysts on Wall Street begin to re-rate expectations over at the trade desk. And as these growth rates begin to slip, well then so will the expectations over at the trade desk, and that huge valuation, nearly 73 times a forward earnings multiple, nearly 25 times a sales multiple, certainly won't be demanded by a company growing maybe just in the mid-teens. And look, Meta in their latest quarter grew at nearly 20%. Google still, despite its huge scale, is growing at 11%. And so just mid-teens growth for a company still posting less than $1 billion in quarterly revenue, just simply not good enough. And that is being shown by the trade desk's after hours reaction. Now, from a financial perspective, like we talked about, there's a few red flags to watch out for, and you see those pop up over at the trade desk. Sure, you have revenue growth from 600 million up to 740 million. Most recent quarter, that was good for 22% growth on the top line. For the full year, you went from about $1.95 billion up to call it $2.45 billion in top line revenue growth. But you are seeing those operating expenses continue to, in fact, grow faster, or at least relatively in line with your revenue. And that's never a great sign, especially not a great sign for a company still relatively at a small scale. You would rather see, or you would like to see, revenue grow far faster than those operating expenses. But in fact, you're seeing platform operation expenses go from 100 million up to 135. So that right there is 35% expense growth. You're also seeing sales and marketing go from 127 up to 150. Tech R&D go from 100 up to 130. And then G&A is the one line where you were able to control those expenses and keep them flat on a year-over-year basis. For the full year, similar story. You are seeing those expenses rise relatively in line, and then the G&A side is being controlled relatively nicely. But all things considered, total operating expenses went from 461 up to $545 million in the most recent quarter. So that is about 19% growth, while you're growing your top line about 22%. So you are seeing some leverage there by growing your revenues a bit faster. But I mean, for a Q4, putting up just $200 million in operating income for a company valued close to $60 billion in market cap is simply not good enough. The valuation needs to certainly come down and more in line, and I think that's what you're seeing. The after hours, I mean, if the stock opens up close to $90 a share tomorrow, this market cap will be closer to $40 billion, and even then, these numbers still are tough to put into perspective for even a $40 billion market cap, let alone a $60 billion market cap. And you come down to your net income, looks fairly good, as you got a one-time benefit from some provisions for income taxes. Last year, you put away a bit more money aside for those income taxes. This year, didn't have to put nearly as much away, and so your net income looking fairly good on a year-over-year perspective. So despite pretty strong revenue growth at 22% on the top line, your expenses continue to grow, and that is troubling over at the trade desk. The other thing to note is you have a fair amount of stock-based compensation. Nearly $130 million of this $545 was from stock-based compensation. And so that's a bit concerning. You still have huge amounts of stock-based comp going over at this company. Now, because they're paying their employees in stock and not in cash, their balance sheet is one thing that still looks relatively good. You have nearly $2 billion sitting in cash, short-term investments. That's not balanced out pretty much by anything, as you have about $2.6 billion in accounts payable. That is balanced out by close to $3.3 billion in receivables. So this company not having any debt really on their balance sheet. They don't have a ton of property, plant, and equipment, not a lot of operating lease liabilities as well. So from a balance sheet perspective, pretty good over at the trade desk. Now, from a cash flow perspective, look, your operating income looks pretty good, from 180 now up to close to $400 million. And you come down to your cash flows, that looks great, and up to nearly $740 million. But keep in mind, for the full year, you get to add back close to $500 million, nearly $500 million in stock-based comp for the full year for a company that's printing underneath $400 million in bottom line net income. So look, we talked about it at the start. Keep an eye out for stock-based compensation. That tends to hurt companies like Pinterest, Snapchat, and Reddit a lot more, simply because they haven't reached the same scale that Meta and certainly Google have reached. And so you're not able to generate huge amounts of bottom line profitability. And so once you get to add back a lot of that stock-based comp, well, then your cash flows still look relatively okay, close to $740 million year over year. That is up pretty nicely. But again, keep in mind, we're talking about this company in the context of a now $40 billion valuation. Even then, $740 million of full year operating cash flows, in my opinion, simply not good enough. I mean, the valuation still looks absolutely gigantic over at the trade desk, and the growth rates, in my opinion, aren't supporting a valuation this large. And now, in terms of investing activities, they don't have a ton of capex. They do still have about $100 million in property, plant, equipment and capitalized software capex. So about 630, call it $620 million in free cash flow is what this company put up for the full year of 2024. And well, with that, what they do is buy back the stock to the tune of about $230 million, and then the rest they sort of add on to their balance sheet. But in my opinion, bit questionable to do a nearly $200 million buyback with your shares trading very elevated, very rich over the past 1 year, also as your stock has climbed nearly 63%. But I'll let you be the judge of whether you want a company you own buying back stock at such elevated valuations. And so from the financials, I mean, it looks okay. You're still growing, your balance sheet looks okay, but the expenses continue to remain pretty elevated over at this company, and the net income certainly doesn't support a valuation close to $40 billion. Even in my opinion, the cash flows simply don't support the valuation close to a $40 billion market cap. Now, from a technical perspective, you're seeing shares slice through just a number of support levels. You were coming into the sprint trading near the top end of a relatively well-defined uptrend, and you broke through pretty much that whole uptrend, breaking down from your bottom range of that uptrend. In my opinion, when it's pretty unclear to figure out where you'll find levels of support, what I like to do is kind of pull up a fixed range volume profile. You sort of snap this on over the past couple of years, tells you where the volume for shares of the trade desk are, and you see as you come down underneath $90, $80 a share, you have lots and lots of volume there. And then really the level of support where I see shares kind of settling out is likely back here down in the 60s, call it maybe low 70s, as you have lots of volume down there. And that sort of coincides with a previous level of support we've seen back in 2023 and in 2024. So it certainly wouldn't surprise me if shares of the trade desk sort of cut through all of these levels of support, continue to trend downwards, come down somewhere in the low to mid 70s and find some footing there. Until then, really, I think the stock is an absolutely no touch for me. It's considered certainly a falling knife at the current time, but I think even if you were to put a nearly $40 billion market cap on this one, the financials, in my opinion, certainly don't support it. And especially when you have other names in the advertising space like Meta, like Google, even now like Netflix and Amazon doing really well. They're continuing to certainly grow and take market share, and while doing it in a profitable way. I think buying and holding your third tier advertising names tend to be relatively hard. You could sprinkle some money in there, but I would actually be far more picky in when I get in and get out of these third tier advertising names like the trade desk. They can certainly make for good trades when you pick them up at the right valuation. That was my take on the trade desk. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.